By the time I opened my business bank statements side by side on the kitchen table, $84,000 was already gone, not misallocated. Gone moved quietly and deliberately across 36 months of falsified records I had been handing to the heirs, with my own signature on top. My accountant had spent 3 years convincing me I was a bad businesswoman. I believed him until I found line 14 buried on page 4 of a quarterly summary. He had labeled it a routine infrastructure cost. What it actually was would take me another 6 months to prove. But to understand why that mattered, you need to know exactly who my accountant was and why I almost let him win. By the end of this, you will understand how a forensic audit a process most small business owners don't know they can initiate independently unraveled 3 years of deliberate financial manipulation. You will understand why the most effective fraud doesn't start with taking money. It starts with making the victim doubt their own competence. That was the architecture of what happened here. And it was not accidental. The mechanism my accountant never once considered when he built his system was already waiting in the record. I ran a boutique marketing agency for 11 years before I hired my accountant. I was not careless with money. I tracked every vendor invoice by hand before automating anything, and I paid contractors 2 days early because I knew what it felt like to wait on payment. Those were habits I had built deliberately, the kind of discipline that lets a small business survive on thin margins without a safety net. They were also, I would later understand, the kind of habits that made me easy to exploit, because I extended the same precision I demanded from myself to the people I hired. My accountant, I will call him Gerald Price, came recommended by 2 separate colleagues I trusted independently, with no connection to each other. His firm served over 200 clients across the county. He held a CPA designation going back 18 years, and his office wall carried a full grid of framed certifications I noticed on our first meeting and filed away without further thought. He arrived 5 minutes early to every appointment, and on our second meeting, without being asked, he told me I was undercharging for my retainer packages by roughly 30%. I did not hire him because of the credentials. I hired him because of that comment. It felt like the kind of thing a person gives you for free before they ask for your trust. The first year felt like breathing room. My quarterly filings were on time. Gerald handled the vendor reconciliation, the depreciation schedules, the estimated payment calendar. I reviewed his summary reports each quarter and signed them. I was not negligent, I read every page. But I was reading as a business owner, not as an auditor. I was looking for the numbers I understood. Gerald understood precisely which numbers I didn't. Year 2 was when the margins started narrowing. Gerald attributed it to rising software costs and a shifting client market. He was composed about it, analytical, in a way that felt reassuring. He pointed to specific line items in the reports, vendors I didn't always recognize, services he described as back-end infrastructure costs. I asked about them. He answered with enough specificity that I moved on. I would later understand the difference between an answer that satisfies and an answer that is designed to satisfy. From the inside, they look identical. By year 3, my profit margin had dropped from 22% to 6%. Gerald's explanation remained consistent: market headwinds, client attrition, labor cost increases. He suggested I consider scaling back. I worked longer hours instead and told myself the business would stabilize. In November of that year, I sat across from my husband at the kitchen table, the same table where I would open those bank statements 14 months later, and told him I wasn't sure the agency would survive another fiscal year. He didn't argue. He just set his coffee down and said, "Did someone ever verify his numbers? Or just you? I didn't have an answer. I pulled the bank statements myself. Not Gerald's summary, reports the raw statements directly from the bank portal, downloaded month by month, going back to the first quarter of our engagement. The first thing I found was a vendor payment in March of year one, $2,400, listed under infrastructure, paid to a company called Meridian Administrative Solutions. I searched for it. No website, no listed address, no active business registration in the state. What I did find was a dissolved LLC registered 8 months before Gerald and I had signed our engagement agreement. The second discovery came from cross-referencing Meridian against every subsequent statement. Meridian had been paid 41 times over 36 months. The amounts varied just enough to stay below the threshold I used for manual review, $1,600 here, $3,200 there, never the same amount twice, never high enough to trigger a closer look. 41 payments, 41 months of what I had signed off on as operating costs. But the third thing I found was the one that stopped me cold. I found Gerald's name, not his firm name, his personal name, listed as the registered agent on Meridian Administrative Solutions' original state filing. The registration date was 62 days before I had signed his engagement letter. The company had not been built to provide services. It had been built to receive payments. And it was built before he ever sat across from me. I closed the laptop. I sat without moving for a long time. Over the following 4 days, I requested copies of every original invoice Gerald had ever submitted on my behalf, and ran each one against the bank's vendor database. Alongside Meridian, I found a second entity, Apex Data Services LLC, registered in a neighboring state. Different state, different LLC number, different registration date, but the same structural pattern, same payment schedule, same absence of any verifiable services, same dissolution the following fiscal year. He had dissolved Meridian at the exact point in our engagement when my year-end reconciliation would have generated closer scrutiny. Then migrated the billing to Apex without changing the interval or the methodology. This was not improvised. This was maintenance. I found 2 other former clients through a professional network, people who had quietly stopped working with Gerald and, like me, assumed the problem was themselves. The first was a woman named Sandra Holloway, who ran a small logistics firm. After we compared bank records side by side, we calculated she had lost $61,000 through the same 2 entities over a shorter period. The second was a man named Marcus Trent, an independent contractor in the trades, who had closed his business the previous spring after concluding that he had simply failed at entrepreneurship. His loss, once we mapped the transactions, was $47,000. Gerald had run this scheme against at least 3 clients simultaneously. The same ghost companies, the same calibrated payment intervals, the same explanation, market conditions, labor costs, the client's own poor decisions. I sat in my car in my own driveway at 11:30, the porch light on, and ran the number 1 final time. Not Sandra's losses, not Marcus's. Mine alone, $84,000, distributed across 36 months, in amounts small enough that I had approved every single one. He had built the system so that the victim would sign their own name above the theft. I spent 3 weeks building the documentation before I showed it to anyone. When I brought it to my business attorney, he reviewed it for 40 minutes and told me the pattern was compelling, but that pursuing it would be expensive, slow, and uncertain. You'd be litigating against a licensed professional with 200 clients and 18 years of records, he said. These cases can take years, and juries don't always understand accounting. He was not being unkind. He was being honest. But the net effect was that I left his office with a binder full of proof and no clear path forward. My bank's business advisor was blunter. Accounting disputes were notoriously difficult to prosecute, he said. The dollar amounts significant to me were unlikely to attract the attention of state regulators. My best option was probably to absorb the loss, part ways quietly, and rebuild with a new firm. He said it the way people say things they believe to be settled, plainly, and with the assumption that the matter was now closed. I drove home from that meeting and sat in the garage with the engine off for a long time. I had the documents. I had 2 other victims willing to corroborate. I had a registration date on a dissolved LLC that predated my signature by 62 days. And the 2 professionals I had trusted most had both, in different words, told me to let it go. I came close. There was a Tuesday in February, just past midnight, when I was sitting at the kitchen table with the binder open in front of me, and I genuinely considered closing it and putting it in a drawer. The math felt too large. The process felt too long. And somewhere underneath both of those things was a particular kind of exhaustion that comes from spending 3 years believing you were the problem. And then I did something nobody told me to do. I opened a blank document and started writing down every question I couldn't answer. Not accusations, not a legal brief. Just the things I didn't know that I needed to know. Who certified Gerald's work each year? Was there a professional bond requirement for CPAs in my state? Could a forensic accountant produce an independent analysis that a licensing board could formally act on? I had 23 questions on the list by the time I stopped. I had no answers yet. But the questions told me something the conversations with my attorney and the bank advisor had not. The door wasn't closed. It was just a door I hadn't tried. The list I wrote that night became the framework for everything that followed. I hired a forensic accountant, a completely separate engagement, entirely independent of Gerald's work, retained specifically to produce a third-party analysis of every transaction Gerald had processed on my behalf over 3 years. I paid her from personal funds. I did not tell Gerald. I signed nothing that would have required disclosure. What she produced, 6 weeks later, was a 63-page report. She confirmed both entities. She confirmed the registration dates against the payment history. She identified a third pattern I had missed on my own, a series of expense reimbursements Gerald had submitted on his own behalf, approved by me as the account holder, for travel and materials he had attributed to client-facing work. 11 reimbursements over 2 years. Not one of them aligned with any deliverable in my project records. But the detail that changed everything was in the methodology section of her report. The payment amounts to Meridian and Apex had not been random. They had been calibrated. Gerald had run a parallel calculation, tracking my average quarterly review threshold, the dollar amount above, which I tended to ask follow-up questions, and he had kept each individual payment $200 to $400 below it. Every single payment. For 36 months. That level of precision did not emerge after the embezzlement began. It required planning before the first payment was ever sent. I had 2 tools available to me that my attorney had not mentioned. The first was a complaint to the State Board of Accountancy, the body that issues and revokes CPA licenses in my state. A licensing board complaint would not recover my money, and I was clear on that. What it could do was open a formal investigation into Gerald's professional conduct, compel him to respond under oath, and if the findings were substantiated, revoke his ability to practice. That was a different outcome than money, but it was not a small one. The second was a civil suit, which the forensic report now gave me the evidentiary foundation to file against Gerald personally, not just his firm. And one name I kept coming back to: Gerald had processed tax returns and financial statements for dozens of clients. If the pattern held across 3 of us, there was no structural reason it stopped there. I submitted the board complaint on a Wednesday morning. I printed the form at my kitchen table, walked it to the post office myself, and wrote 4 words at the top of the cover page, supported by forensic documentation. Then I sealed the envelope. I did not wait for a response before I moved forward. I moved forward and let the response find me. The State Board of Accountancy acknowledged receipt of my complaint 14 days after submission. The investigation that followed took 9 months. I want to be precise about that, because the way these stories are often told compresses the waiting into nothing, and the waiting is part of what actually happens to you. 3 months in, the board assigned a formal investigator to the case. She contacted me with a follow-up documentation request, every transaction summary, every invoice copy, and the complete 63-page forensic report. I provided the full package within 1 week. Sandra Holloway and Marcus Trent submitted parallel complaints with their own documentation the week after I gave them the investigator's contact information. 3 separate complainants. 3 separate forensic trails pointing to the same 2 dissolved entities. At month 5, the investigator called me with a question I had not anticipated. She asked whether I had ever received a document from Gerald titled a client infrastructure ledger. I said no. She told me that 3 of Gerald's current clients active, not former, had contacted the board voluntarily after receiving an unsolicited email from Gerald following what appeared to be an automated flag on his practice account. He had, it seemed, detected movement connected to his license number and had moved quickly to make contact with clients he was still actively serving. The investigator did not tell me what the email contained. She noted only that the pattern of outreach was inconsistent with standard professional communication and had been flagged accordingly. I asked her what the email had said. She paused. Then she said, "That's actually one of the things we're looking into." The board's formal findings arrived at month 9. Gerald Price's CPA license was suspended pending a full disciplinary hearing. The findings cited 3 specific violations of the state accountancy code: billing for services not rendered, operating undisclosed affiliated entities that received client funds, and falsification of client expense records across multiple engagements. The investigator's report further noted that the case had been referred to the State Attorney General's office for review of potential criminal statutes. A licensing board does not prosecute criminally. That referral sat with the AG, and it would move on its own timeline. Separate from the board findings, and separate from our civil action. And then came the part I did not expect. The forensic accountant I had retained was contacted by the board's investigator independently, not through me, not at my direction. During that conversation, she shared something she had noted in her report that I had read but hadn't fully absorbed at the time. The calibration methodology Gerald had used to keep his payments below my review threshold was not something she had seen in isolation. It was a documented pattern in forensic accounting literature, a named approach, with case studies attached. Spanning multiple practitioners and multiple states over the preceding decade. Gerald Price had not invented his system. He had learned it. From somewhere. Or from someone. The board's investigation ultimately identified 9 separate clients who may have been affected by Gerald's billing practices. 5 submitted formal documentation. The estimated aggregate loss across documented cases exceeded $300,000. The civil suit Sandra, Marcus, and I filed jointly was settled out of court 11 months after the board complaint was submitted. I cannot disclose the specific settlement terms. What I can tell you is that the combination of the forensic report, the board's findings, and the ag referral created a negotiating environment that my attorney described as unusually favorable to the plaintiffs. The recovery did not undo 3 years of inflated hours and compressed margins. It didn't restore the Tuesday night I sat in a dark car wondering whether to walk away. But it was real, and it was documented, and my name was on the right side of it. Gerald Price's CPA license has not been reinstated as of the date of this recording. His firm's website is no longer active. Line 14, the infrastructure cost that appeared on page 4 of my quarterly summary, 41 times, under a company name that never existed, is now Exhibit A in a formal record that cannot be amended. Here is what justice did not do. It did not give me back 36 months. It did not undo the November evening I told my husband I didn't think the agency would survive. It did not return the nights I worked past midnight trying to recover margins that were being quietly drained while I signed my name at the bottom of forms I trusted. It did not undo the 41 times I approved a payment to a company that did not exist and called myself a careful businesswoman. What justice did do was this: it closed a door. Gerald Price had been operating this pattern in various forms for at least a portion of his 18-year career. The forensic methodology he used was not improvised. The shell companies were registered before the relationships that funded them. The calibration of payment amounts was precise enough to survive 36 months of quarterly review without triggering a single follow-up question. This was not opportunistic fraud. This was practiced fraud refined, maintained, sustained, and apparently learned from an established playbook that had outlasted multiple accountants across multiple states. What I built and what Sandra built and what Marcus built was a folder, a 63-page forensic report, a set of raw bank statements downloaded month by month, and a list of 23 questions written at a kitchen table at midnight when 2 other people had already told me to stop. That folder is now part of the formal record. It cannot be unsubmitted. It exists in the board's files, in the AG's office, in the civil settlement documentation, and in the investigator's report that was sent to a body that refers cases to other bodies when the scope turns out to be larger than any single filing anticipated. The next person Gerald Price approaches, if there is a next person, will not start from zero. I was not the first client to lose money to him. I was the first to document it the way it needed to be documented. Some doors close on their own. Others require someone to stand at them and hold them shut. I held mine, 36 months late. But on my own terms. 6 weeks after the civil settlement closed, I received a message through a professional network I had been inactive on for over a year. The sender ran a small consulting firm in another state. She had been referred to me by someone she declined to name. Over the past 2 years, she said, her margins had contracted steadily, and she couldn't account for it. Her accountant had been organized, composed, and had come to her through 2 separate referrals from people she trusted. She asked me if she thought it was worth pulling her raw bank statements. I told her, always pull the raw statements. Then I asked her who her accountant was. When she replied with the name and the former firm affiliation listed alongside it, I went very still. I had seen the name before. not in Gerald Price's personal records. In the board investigator's report, in a section I had not been asked about directly. A former associate. One passing reference in a document that ran 67 pages. Drop what you find in the comments. You may already be one piece of someone else's folder.